Hi guys, this is Investing with JYK. Today we'll talk about a little bit economic cycles. It's quite late, so I'm gonna make this one really short. So I collected some data, and um, so it may look like crazy crap here, but that actually is very interesting. So I started off thinking um, that I've been seeing a lot of jobs need, for hire signs just around me. Almost anywhere you go, it's for hire. I started noticing it about 2, 3 years ago where I live. The uh, the car washing places started posting signs. I was like, that's a good sign. If people want to wash their cars, they actually got money to spend. Then I noticed that the car wash place started raising prices. I'm like, okay, it went from somewhere around $14 to like $24 now. And the other thing I noticed later was that as I was traveling the country, I see more and more signs on trucks. And now what I see is that all the trucking all the trucks have a sign that says drivers needed. And they put it in various languages. It'll be in English, in Chinese, and then in Spanish. And all these fast food places have for hire signs. And it's just, well, not for hire, like hiring signs. So, so initially my thought was, if everybody needs new workers, that probably means um, we're gonna end up with wage inflation. We should see wage increase. So I started collecting some data, and this is what I found. So these are the raw data that I pulled from Fred. So Fred, you can search it on here as well. So I just pulled down the data. So these are all the raw data essentially. Right, so I pulled down the data and did a bit of post processing. And what we have is real GDP growth, so adjusted for inflation, and then CPI growth. Well, I had CPI growth here, this column, and also wage growth. So the red line is the GDP growth, and green line, sorry, blue line is wage growth, and green line is unemployment. And some things are fairly interesting. Um, so one thing is that it doesn't seem like, towards the end of a cycle, you actually have a real wage growth. It um, basically adjusted for inflation. You can see the wage growth is almost usually before we enter recession. So you can see these are recessions, right? When the red line dips below, that's a recession. You got a recession here, you got a recession here, you got a recession here, and again a double dip recession, and then one here, and one somewhere here, and then 2008. So these are all the recessions. And then people were worried about 2011's double dip recession, all that stuff. Um, so close to the recession time, you actually don't have that much of a wage growth. Even in here, the whole thing never went above positive in the 1980s, and you still end up with a recession. But this is, I think, this is the Gulf War and all that crap, and 2000s really the wage growth came way down before. I mean, that's an interesting thing actually. The dot-com bubble started bursting here, like, so if you call this, but this is a single data point, um, and and then the other funny thing is that you got this real dip here, and then your real wage actually goes up. So basically, people think they're poorer But actually, because of deflation, their money is actually worth more. It's quite crazy. And in here, you see this real wage growth is actually not a real good predictor. It's most somewhat follows. It has a pretty high correlation with the GDP growth, real GDP growth. So then I thought, okay, so what does the unemployment data look like? So that's the data I collected. I found, not collected. I found in Fred, and then you can see that whenever it goes below 4, especially if it plateaus after 4, so if you think almost like the second derivative of the change, um, you get a recession, right? So recessions rarely happen when you have like really high unemployment rates. So that's a super interesting thing. So this graph isn't super good, but maybe if you look at this, right? So if you look at that, this is amazing. Look at the recession. When recession hits, you're typically at a low unemployment rate, which makes sense. The economic cycle booms and you get employment, and it keeps going better until it gets worse. And typically the first few years after a recession, you get a huge drop in unemployment rate, and that explains why economy would be growing. If you think about it, how does an economy grow? You either have a single person. Well, what is an economy? Right? Economy is really just someone producing, people producing. The aggregate production of a country is its economy. Now, how do you make a country produce more in aggregate? You either make a single person produce more, or you make the more people produce, right? So when a recession ends, what happens is you have a bunch of labor that are not being utilized. So you can now afford. So basically, you can just do like almost like copy paste. You just need to copy paste and the jobs, and then everybody. The more people get employed, the higher in production goes. So that's super interesting. And then the other thing is, you can see that at the before the recession, before the actual start of the recession, you typically have except here you actually have the golden years in the 50s or whatever. You get a pretty long stretched out number of years of low unemployment. This is insane, 2.5% unemployment. That's as close as full employment as we've ever got. But if you watch the others, you typically get a turn in unemployment numbers or a slowdown in unemployment decreasing, right? So for this one, you have a quite good lead. You got almost like a whole year of lead. Here, here basically the recession hit. But that's the oil shock, so that it's a shock. It's not like driven by the debt cycle. It's actually driven by an external event. Here you actually have a bottoming out and actually turn up before you got a recession. Here's a double dip, right? But this one here again, 1990. Even though this is the oil thing, you can see that actually bottomed out and then it increased. Obviously, this would look very similar to here. So if you actually if you thought this was the bottom, then this was the bottom, and inflation would increase. Sorry, unemployment would increase from here and cause a recession. I think this is not just causing; they kind of act on each other. Then you would be too early. But then here, you should be looking at both the rate of the change and the absolute number. So at 7%, you still have a plenty of people to draw on for more production. But yeah, at 4%, then you're almost half there, and we are now at 4%. And I don't see this thing, I don't see like a real bottoming out yet, but this kind of tells us, to me at least, how far do you have to go, right? If you look at this, how far do we have to go? Can we ever reach full employment, like full employment? No, you cannot. They're just bad people. They're people that don't want to work, cannot work. They're impaired in some ways. So, and then the lower you go down here, the worse labor you get. If you think about it, the ones that got employed here are, if you think about like marginal employment, right? So the jobs that produce the least value will get cut in here, and then they will cut until it like cuts into the value spectrum. So you're here, and then if you're employed, if you start getting, I mean, it's bigger. If you start getting employed down here, then you're, imagine the value spectrum starts shifting. These are the people that get sucked in. So they get the, so these jobs are held by the people that, in my mind, right? I mean, this is my guess. There's no data backing this. Um, the people that are more industrious, and the people that are more capable. As you go down and down, you eventually run out of the more industrious and capable people, and you have to find worse labor. So the marginal increase to the production is actually going to be limited. The further you go down the unemployment rate. Yeah, so this is, I'm not saying we will have a recession just yet, but but from this we can clearly tell that we're at least closer to a recession than we are to, well, we're closer to the end of the cycle, of this cycle, than to the beginning, right? So this is how I kind of think about this. And obviously you can see the spread between each recession is somewhat limited. People fall for the same crap. The longest we had before was like the 10-year here in the 1960s, and maybe the 1990s. Maybe we can get another 10-year economic cycle. That's reasonable. We could even get a 15-year one. But just think about, what does economic growth mean? You either drive up productivity by technology, which is actually either technology or capital, or you put in labor. And at least we're almost exhausting the labor option. And okay, so yeah, just some macro stuff, some observations. Check out Fred. They have a bunch of interesting things. Before we conclude, let me just show you a couple of things that I find very interesting. Obviously, we've seen the GDP, the wage average hourly earnings, and the other one is Fed rate. Effective Fed fund rate, and what the hell? Oh, what? Yeah, so we are on this long-term downtrend that kind of bottomed out here because there's a zero, and if you go negative, people go crazy because they'll start hoarding whatever crap, gold, right? Because at least you can't take gold away from me. And you typically hike it until it dies. So hiking is usually closer to the end of the cycle than to the beginning. You obviously have a exception here where you kept on hiking, but even here, this one is, once you started hiking, very soon it's closer to the end than to the beginning. So when here you got two crazy hikes, and somehow that did not cause a recession. I don't understand what's going on there, but these seems like spikes. Be interesting to read about these. And yeah, so that's one. And the other one, maybe you might be interested, is like housing starts, single family housing starts or something. That is actually quite interesting too. You got, you can see we're actually fairly low. We're at 1970s level, even though the population is much higher. So this is not per capita. If you do this per capita, you show a very different number. And this is one of the reason I'm long LGI homes. I think, in fact, most home builders, but especially the cheap home builders. All right, so I hope you got some value out of this, and if you like this channel, please subscribe and click like. If you don't like this, click dislike and leave comments. Let me know what you need from me or what you want to hear about. And I'll try to accommodate. I know there were 5 of you that have submitted some requests, and I haven't gotten to some of them. And I'm sorry, I'll try. And yeah, thanks. Haven't stopped, have I?